Market don't crash when people are worried. They crash when no one is. And that's the scary part, because by the time people start to panic, it's usually too late. Whether it's rising inflation, stubbornly high interest rates, global conflicts, or cracks in the housing market, there are always warning signs, but most investors still get blindsided. That's why smart investors don't wait for the headlines. They prepare while things still feel calm. In today's video, we're breaking down 10 Canadian stocks built to weather economic storms. Companies that can protect your portfolio, deliver reliable income, and stay steady even when things get rough. Some pay generous dividends, others dominate essential industries, and a few quietly grow year after year without much hype. But they all have one thing in common: they're built to last. If you want to add stability to your portfolio and still earn consistent returns, even during a downturn, you're in the right place. Tap the like button, subscribe to Bucks and Beyond, and let's jump into 10 Canadian stocks that can thrive through tough times. At number 10, we have Fortis, ticker FTS.TO, the definition of steady. Let's start with a company that's all about consistency, Fortis. Fortis is one of the largest utility providers in North America, serving 3.4 million customers in Canada, the US, and the Caribbean. It delivers electricity and natural gas, things people need, no matter what the economy is doing. Nearly 99% of Fortis' revenues are regulated, which means they're stable and predictable, even in a downturn. While other companies see earnings fall during recessions, Fortis just keeps doing its thing. It's also a dividend machine, increasing its payout for 50 years straight. The company aims to keep raising its dividend by 4 to 6% annually to 2028. As of now, Fortis pays a dividend yield of around 3 to 4% distributed quarterly. It's not flashy, but that's the point. It's reliable. At number 9, we have Loblaw Companies, ticker L.TO, groceries and pharmacy stability. When money gets tight, people cut back, but not on food and medicine. Loblaw is Canada's largest grocery and pharmacy chain, with over 2,400 stores across the country. Whether you shop at Superstore, No Frills, or Shoppers Drug Mart, you're shopping with Loblaw. During recessions, discount banners like No Frills actually gain customers, as shoppers look to save. And with its pharmacy business through Shoppers, Loblaw taps into healthcare spending, which tends to stay strong no matter what. Add in strong cash flow, smart cost controls, and growing online business, and you've got a defensive powerhouse. Loblaw pays 1 to 2% dividend, issued quarterly, modest but reliable, and backed by a rock-solid business. At number 8, we have Metro Incorporate, ticker MRU.TO, the quiet performer. Metro doesn't make headlines, but it quietly delivers year after year. This Quebec-based company runs over 950 food stores and pharmacies, including Metro, Super C, Jean Coutu, and Brunet. Its focus on Ontario and Quebec, two of Canada's most stable provinces, gives it a steady customer base. Metro is lean, efficient, and disciplined. It keeps debt low, runs with strong margins, and grows earnings consistently, even when times get tough. It has also raised its dividend for over 20 years straight. Today, Metro pays 1 to 2% dividend, distributed quarterly. It's not the loudest stock on the list, but it is one of the most dependable. At number 7, we have BCE Incorporate, ticker BCE.TO, connectivity you can count on. In a downturn, people cancel a lot of things, but their internet, that stays. BCE, or Bell Canada, is the country's largest telecom company. It provides mobile, internet, and media services to millions of households. Let's be honest, Wi-Fi is as essential as water these days. Telecom is sticky business. Once customers sign up, they tend to stay. Even in hard times, people keep paying for phone and data plans. BCE pays 5 to 6% dividend, distributed quarterly, and it's supported by strong cash flow. Yes, it has high capital spending, but its income is stable enough to support both the network and the payout. When markets get rocky, BCE becomes a safe haven for income-focused investors. At number 7, we have Canadian National Railway, ticker CNR.TO. The economy might slow down, but it doesn't stop moving. Canadian National Railway is a key part of Canada's transportation network, hauling everything from grain to cars to chemicals across the continent. Railway is one of the cheapest ways to move freight, and when companies cut costs during a recession, they often shift more volume to rail, benefiting CNR. With a wide economic moat, low debt, high efficiency, and long track record of dividend growth, CNR is built for resilience. It currently offers 2 to 3% dividend, paid quarterly. This is a classic compounder that keeps your portfolio on track, even when the economy isn't. At number 5, we have Waste Connections, ticker WCN.TO, profiting from the basics. One thing is for sure, garbage never stops. Waste Connections is one of North America's top waste management companies, operating across Canada and the US. It handles residential, commercial, and industrial services. Because it signs long-term municipal contracts, its revenue is recurring and predictable, even in tough times. And since garbage pickup is essential, customers rarely switch providers. During slowdowns, Waste Connection often buys smaller competitors at a discount, growing while others shrink. The company pays 1% dividend distributed quarterly, modest but reliable, and steadily growing. At number 4, we have Canadian Apartment Properties REIT, ticker CAR.UN.TO. When money is tight, people might cut spending, but they still pay rent. Cap REIT is one of Canada's largest residential landlords. With over 44,000 rental units, it focuses on affordable and mid-range housing in major cities, properties that stay in demand during downturns. Even if property value dips, rents often hold steady, especially with limited housing supply. Cap REIT pays a monthly dividend with a current yield of 3 to 4%. That monthly income is a big plus for investors looking for a reliable cash flow. While retail and office REITs can struggle during recessions, residential ones like Cap REIT often shine. At number 3, we have Almonte Couche-Tard, ticker ATD.TO. Couche-Tard may not be a household name, but Circle K probably is. This company runs 17,000 gas stations and convenience stores across 29 countries. It sells fuel, snacks, coffee, and quick essentials, things people still buy even in a downturn. During recessions, Couche-Tard goes on offense, buying distressed assets and expanding their network. It is Canada's most efficient operator, with high returns and strong growth. The dividend is small, about 1% paid quarterly, but the real story is its long-term compounding potential. This is a quiet giant that keeps getting stronger. At number 2, we have Power Corporation of Canada, ticker POW.TO. Defensive diversification. Want financial exposure without leaning too hard into the big banks? Power Corp owns large stakes in Great-West Lifeco and IGM Financial, giving it exposure to life insurance, pensions, and wealth management. These services stay in demand, even more so during times of uncertainty. The stock trades below its net asset value, which gives it a margin of safety, and the cash flow from its holdings supports a strong 4 to 5% dividend paid quarterly. For income-focused investors who want stability with some upside, Power Corp is a strong pick. At number 1, we have Toronto Dominion Bank, ticker TD, the one to own. If you're going to own one Canadian bank during a recession, it should probably be TD. TD Bank stands out for its strong balance sheet, conservative lending, and large US presence, making it more diversified than most of the big six. While all banks face headwinds in a slowdown, TD tends to recover faster. It benefits from rising interest rates and stable demand for core banking services. TD currently pays 4 to 5% dividend distributed quarterly and has a long history of growing and protecting that payout. It's big, boring, and beautiful, especially when markets get ugly. These aren't moonshots. They won't 10x overnight, but they can do something far more valuable. Hold your portfolio together when the world feels like it's falling apart. These are stable, essential, and dividend-paying companies, built to survive and thrive in uncertain times. So which one do you own? Did we miss one of your favorite defensive stocks? Drop a comment below. We'd love to hear from you. And if you found this video helpful, give it a like, subscribe to Bucks and Beyond, and ring that bell icon so you never miss a smart investing idea. Thanks for watching, and remember, recession don't last forever, but smart investing does.